Okay, good afternoon. I am Eric Brandt. I am presenting today's APEX discussion. The topic is loss development in the PC insurance industry. Again, as the last remaining people are signing in, I got to take care of a few housekeeping things. And I'll try to reiterate them at the end, for at least most of them. First, I already have a question. We will have the handouts from this presentation available on Pinnacle's website. There will be instructions on that. The instructions on that will be coming in an email you will receive after this presentation requesting feedback and anything to improve these presentations. Further, on that email, you also, if you wish, you can get a certificate to retain for your continuing ed if you are listening to this presentation for maintain continuing education credentials. And with that, I guess we're going to start. So we're going to talk about loss development in the property casualty insurance industry. We here at Pinnacle refer to this as an evergreen topic in that it's a study, and then every year I will perform updates to the study, revamp the slides. My intention behind this is, there's a lot of words, but I'm trying to replace the words with graphs systematically and make it a much more visual presentation. So for those of you who have heard this before, maybe heard it a couple of years ago or coming in now, I hope at least visually the presentation has a lot more appeal. This topic lends itself greatly to charts and graphs. We actually initiate this a lot of the study to help regulators out at their continuing ed, and it's hosted at Illinois State University, which is located here in Bloomington, Normal, Illinois. If anyone's not familiar, that's where I'm located right now. It's not really Chicago, it's the middle of the state. So, we'll move on right now. We're going to first, I'll tell you a little bit about Pinnacle and myself, and there's a bit of background on the actuarial profession. There's some people on here who may not be actuaries that will need this information to put things in context. So we'll then follow and talk about one-year development, and that can be found in the Property Casualty Annual Statement on Schedule P. Then we will talk about this top 30 versus the industry, and I'm going to define top 30 several different times to remind everybody what it is, but not quite yet. And as we go through it, we're going to look at some historical industry figures and then end this presentation with some general conclusions. Pinnacle Actuarial Resources is an independent property casualty actuarial consulting firm. It is headquartered in Bloomington, Illinois. However, we do have several offices around the country. We have New York, San Francisco, Columbus. We have 15 full-time credentialed actuaries. And Pinnacle has a large diversity of work experience as a group. We do loss reserving, ERM, reinsurance, alternative markets, predictive modeling, and several other, things that you generally expect actuarial firms to do. Myself, let's see here, I'm a fellow of the Casualty Actuarial Society. I went to Illinois State, graduated, and actually took a job at this company. I've been here, it says 14 years of experience. I guess I like to round up, and I'm going to say 15. Yeah, I'll change the slide, but somewhere between 14 and 15. My specialty in this company is generally reserving the alternative markets, and I've done some things with private passenger auto as well. And lots of work on captives, self-insured, especially group captives. I have spoken to continuing ed at Illinois State University and the insurance managers of the Cayman Islands. I oftentimes also discuss financials and reserve reports with CFOs of insurance companies or captive membership. Now, we started this study several years ago, and because in the early 2000s, there were a few large insurance company insolvencies and liquidations. A lot of them were Kemper and Reliance, to name two. And aside from those companies, several companies experienced very large calendar year adverse reserve development. That was not the only event that precipitated the Sarbanes-Oxley Act, but it's mentioned in the Sarbanes-Oxley Act, and as actuaries know, it made some rules affecting us. For example, I believe publicly traded companies can't have the same actuary and accountant from the same company do their year-end financials. Then there was the infamous November 2003 S&P article that questioned reserve inadequacies and why actuaries were signing off on reserves, and they were developing upwards, and they used knavery or naivety to describe the profession. And we started developing the study, and then the market went soft, so there wasn't that much attention. But we've still been following up with the study, and I believe this year we're going to see some signs that, I'm not going to declare this a hard market by any means, but things may be, supply may be constricting a bit. Certain indicators, are pointing towards a change in the marketplace. So, basically, we have some questions from this industry development. Again, most of this going to the early 2000s. As a reserve development a cause, a symptom, or a lagging indicator of the industry's problem? So, the SAO, whenever I say that's going to mean the statement of actuarial opinion, which an actuary has to sign for an insurance company saying that a company's reserves are reasonable, deficient, redundant, but they have to be filed by for every insurance company. And, in other words, what is the role of the actuary in setting reserves? So, as I reiterated, this is our ninth look at the top 30. I'm going to define the top 30 first for the first time now, and it's the same definition whenever I refer to this. We take the 1-year reserve development dollar amount, and that's going to be found on the Schedule P Part 2 for the entire, we do this for on a group level because of our software. And then we look at the 30 companies or groups that have the largest dollar amount, those of calendar year development, and those are our top 30. And by calendar year development, we mean development on reserves for accident years 2009 and prior during calendar year 2010, because that's when the last annual statements are filed. We use AM Best as our source for the data, and through some of their tools we can get some statements of actuarial opinion. We use those in collecting data. There's been some changes to the statement of actuarial opinion that make meaningful data easier to collect. That would be Exhibit A and Exhibit B, which has certain numerical amounts in a tabular format. Now, it is my hope sometime that the NAIC or somebody will actually make this stuff available electronically, because right now we're still inputting a lot of data. But I hope that the industry is going that way, because there's a wealth of information out there that people like me have find the industry interesting. So I've got to say this again because it's so important. we're looking at the development of net loss and LAE reserves in accident years 2009 and prior in calendar year 2010, Schedule P, Part 2. Now, right now, so during 2010, overall industry development was favorable. There was over $10.8 billion of redundancy released. However, not everybody's redundant. That's the industry. Several companies have adverse development, and we are going to go our analysis with the top 30. But there's still a couple of industry metrics here. We have this is development as a percent of year-end surplus. And you can see in this square here that I've highlighted in red that it seems to be a lot lower proportion of companies in years 2005 through 2010 and earlier. And as I'm trying to figure out the mechanism, seems to be a greater concentration of companies here in the middle, which I highlighted in a blue square. So naturally, being an actuary, the next step would be to graph this. So we have done so, and the biggest thing is that these yellow and light green bars here are much higher in 2009, 2010, and you can see right here the dark green bar went up and it went way down, and between 2009 and 2010, the dark green bar has started to increase a little bit. The dark green are companies that had reserve developments over 10% of their prior year's surplus. So, we're also going to look at development as a percent of loss reserves. We're going to throw surplus out the window, say, okay, we're not concerned about the underlying piggy bank to deal with. What about how far were we off just in terms of last year's estimates? And again, the highlighted red square easily shows that there's definitely less in number companies that were up from 5% and 10%, although in 2009 and 2010 the number seems to be increasing just a little bit. And naturally I graphed this as well. And on this graph, you can see that the dark green bar, the bar on the farthest right, has in fact risen since 2008. It's in fact a bit more visible here in terms of number of companies. So, one conjecture would be that as a percent of reserves, we're seeing a bit more development. That and you can see that development better when you look at it as a percent of reserves, as opposed to a percent of surplus. And we have this graph here. I said we've done this project for 9 years, so guess what we got? We got a 9-year time series. How about that? So you can see that in 2002 and 2003 and 2004 here. These years here that I'm drawing my little line over, these years had the red bar was industry development is always greater than zero, or the top 30. Well, top 30 is always going to be greater than zero, and the industry development's in blue. So in 02, the industry developed even worse than the top 30. Whereas starting here in 05, the industry development went, increased relative to everything else a bit in 2010. One important thing to note when we're looking at all these numbers, there was a single group in here that participated in some credit default type of insurance products. So they, in 2008, they put up a huge increase in their reserves, and then they took it down in 2009. So it makes this bar chart look kind of funny. However, if you were to cancel out the effects, you'd end up with what appears to be a very smooth curve. I understand that this chart itself is quite busy. One reason I actually published the handouts is because, it'd be impossible for me to cover everything that's in this chart. But I guess I'll point out some what I call highlights, things that you'd expect. And this chart here takes the top 30 companies, and it gives all kinds of metrics. We have a source of adverse development. It gets you some mortgage, and right here we have determination of a reinsurance agreement, and everyone, whether they're taking their actuary exams or reading the trade press, knows that reinsurance can if a reinsurance agreement turns sour, oftentimes it can lead to impairment. And it looks like this company's had some trouble looking at its other numbers. I looked here at the 2010 net loss ratios. These come from a Schedule P, so they're a held loss ratio. You get these three companies here with really high loss ratios, and two of them are mortgage. Still not a good year for mortgage insurance. I guess that shouldn't surprise everyone. And we had apparently the company put up some more asbestos reserves. Over the years, that one's been fairly common. And the company here that was number one, we're talking $5 billion of one-year development. They had their two-year development of $6 billion. In fact, it's over 25% of the surplus, so that would, what do they call that, be a significant value on the IRS test. I have questions that you can type in, and I'm going to periodically look at these questions and try to address certain ones. And people can always email me. I like this topic. I've researched it a lot. So someone says, I have a question of companies in excess of 10% of development. Do I have any idea how many will go into liquidation? Right now, I have never actually gone down that road. And assuming the market goes through another good hard cycle, it'd be nice. That would be a great topic to research. It's been difficult, A, with only 9 years of data, and B, we're coming out of the hard cycle when we started this, so a lot of the companies that were, even on the initial look at this top 30 project, a lot of the companies that were toast, they'd already gone by the time we started the project. There's, we see some growth and surplus and so forth. We're going to talk about these things later. I have the AM Best rating, and whether as an employee or consultant that signs a statement of actuarial opinion. We can, go through the litany of reasons really quick. An employee, when the SAO is signed by an employee, that can be perceived as really good because you'd assume that an employee of the insurance company is going to be the most knowledgeable person about the book of business the insurer writes, as well as their claims and perhaps little financial nuances, if there's done things performing exceptionally good or bad. However, an employee may be a bit more beholden to the company than an outside independent consultant who can come in and independently look at the data and review the numbers, although since the consultant's independent and not in the company every day, then, there has been, it's gone back and forth on which one is better. I will offer no endorsement. I'd say you want an honest, good actuary. Would be my solution. We're going to talk here about, so we're going to look at some of the neat things that are on this chart. We're going to kind of break down and look at in a micro way. So we had 8.4 billion of adverse development in the top 30. Well, that's lower than the 15 billion we had in 2008. Although 10 billion of that was that company that was exposed to a credit default swap. So once we take that into consideration, the top 30 has been fairly consistent. And I note that 2005 had 14 billion in the top 30, and there was no special credit default swap company making up 10 billion of that. That was just the last year where we had huge dollar amounts in the top 30. But I've noticed that it's been, since 06 and 07, which are great years, it has been decreasing slightly. Surplus growth for the top 30 companies has been 1.4%, then significantly down from last year's top 30, and industry growth is 7.4%, and we have those figures right here. So in 2009, our top 30 surplus grew 9%, but in 2010, only 1.4%. And industry surplus growth went from 13 to 8.7. So right now, then we're going to look at the top 30 versus the remainder of the industry, and I guess everyone can read and look at these numbers as well as I can. Well, in 2003, both the top 30 pretty much approximated the industry development, and 2006 industry development negative, the development of the top 30 much lower, same in 07. And as I said, we've seen a slight increase in the top 30 development, especially once you remove the $10 billion from this 2008 number, and then make the counter adjustment to that number as well. The big question is, though, is that, is this the bottom? Is this negative 19? Does the industry have, money to, have this negative development? Can it continue? And it's a good idea to keep in mind throughout several of the graphs coming on up. So, where is all this loss reserve development coming from? Well, traditionally, we've had comments that, asbestos related. There's usually one or two of those a year. Mold, well, I think mold's kind of gone by the wayside. But when the toxic mold, especially some Texas riders, it wasn't a major issue. That's there. Medical malpractice and workers' compensation always seem to be there in one way, shape, or form. And oftentimes they could be from a high-level excess carrier. And excess casualty, I think, is always going to be on there because there's going to be, some company that wrote a contract that leads to terrible losses. Subprime has altered the landscape of this a lot because the financial guarantee insurance used to not be a problem. It's been on there since 2007. 2010, we both had construction defect claims and Chinese drywall claims. I've seen construction defect do some pretty terrible damage to books of business. And I was reading a little bit of trade press, just trying to get some other, views. Not necessarily where, even things will come from, but where will they come from? For example, the mold came out of nowhere and Chinese drywall came out of nowhere. I've always read a couple things like, one was cyber risks, that, some of it's being underwritten, but there is some potential for terrible adverse development as people are maybe uncertain as to how the policies work with respect to triggering damage. Now, the second thing that caught my and this would be to anybody reading any kind of trade press and actually just talking, as an event, talking to some other actuaries this past week, but the reinsurance market really got hit hard in 2011, especially nationally and internationally. There's earthquake in Japan and New Zealand. We had the Joplin, Missouri tornadoes. There's been some other storms. Mexico, I guess, had some pretty good tropical storm damage. And one thing to keep in mind is, once the reinsurance market decides to either raise its rates or restrict terms or availability, that's going to put more risk or different kinds of risk into the primary market. And oftentimes, when you get new risks or you have to take some of that risk back, that may lead to some reserve increases and more uncertainty. So we turn to the statement of actuarial opinion to get a large amount of data for this study. And one thing is what's called the RMAD. It's the risk of material adverse deviation. And that's a statement that's in the statement of actuarial opinion. Simon's very familiar with the term. And you have to, you say the reserves, you could say they provide a reasonable estimate. That's good. Is there a risk of material adverse deviation in the reserve number? You have to state an unequivocal yes or no. You have to give reasons, and you also have to give a specific threshold. And that threshold can be a percent of surplus. We've also seen a percent of reserves. And for companies that are close to the risk-based capital company action level, I've seen $1. If a company has bad risk-based capital ratios, $1, or maybe if it's $87,000 away from company action level, the RMAD threshold would be $87,000. That one makes it quite easy to quantify. But you have to say yes or no. And we have a fairly small sample size here that I noted by end of the slide, but in the past 9 years we have been trying to figure out the RMAD. Now I'll tell you what, going through these opinions in 02 and 03, you had to do a seek and destroy mission to even find them sometimes. Whereas now, 08, 09, and 10, since it's been hammered into everybody that you have to have a statement, yes, there is a risk of material adverse deviation, or no, there is not, it's easier to find it. So I'm going to say it seems between 60 and 75% of companies seem to have a risk of material adverse deviation in their reserves. And again, this is from a fairly small sample size. And in conjecture at the bottom, 46 of these appointed actuaries this past year are in percent. Which you would expect, companies are having a bad year or two and they're increasing their reserves. At 06 and 07, though, when there wasn't nearly as much activity, even in the top 30, so most of those companies had really good loss ratios. So the paragraph on the RMAD generally lists, I'm going to go over this just to make sure we're all clear. Is there an RMAD in the actuary's opinion? Is there a threshold? The reason for the threshold and the risk factors for the insurance company. And a lot of that really busy chart, that's where we get a lot of our risk factors would be from the RMAD. It's a very valuable sentence. Now, some companies don't have an RMAD. In fact, some of the companies that have made the top 30 don't have an RMAD, obviously. And so some companies have a large surplus and very limited long-tail exposure. You could think of large property writers. Well, property is a short-tailed line, and You may have an unfortunate, uncertain event like a very damaging occurrence that happens at the end of an accident year, but property is a lot easier to estimate. And, if you have a large amount of surplus, you may not have an RMAT. Some companies do have such limits on their policies that the idea of having large increases in reserves would be quite rare. And talk about property, other fast-selling lines. You may not necessarily need an RMAT. Okay, I have a couple more questions. I'm gonna look before I go to a few graphs. We will be discussing later on. We're gonna be discussing industry reserve development, and we'll be graphing it with some investment earnings and other underwriting earnings and some other things, and some really exciting graphs. There's another question about the RMATs. Have we ever looked to see if there was a prior RMAT in the year-end SAO? The answer to that is an indirect no. However, we'll find that some of these companies have been participants in the top 30 list a lot more than one time. So, and those companies, a lot of times you can say, yeah, they had RMAT the year before and the year before. And, a lot of these companies have RMATs for obvious reasons. They're on this list. There's been thoughts to take this development study. For example, now that we actually have a dollar threshold for the RMAT, and since you have to mandate the dollar threshold, and since it's on, I believe, that Exhibit B of the Statement of Actual Opinion, if and when we either A, get that data electronically, or I can get an intern or something to plug all that data in, it'd be interesting to compare the reserve development to the actual dollar amount RMAT threshold. That is a very large topic of interest. The problem is, right now, SAOs are quite cumbersome to download. You have to open up each PDF file and print it, and I guess you could either scan stuff in manually or have someone input it, but it's still quite time-consuming right now. But those are some ideas, and this is an evergreen topic, so maybe next year. Right now, we're going to discuss the 30 companies. So I got this 30 companies, and I was going to tell you a little about them. Some of these guys are large, national, multi-line, very stout companies. Some are niche writers. They write one or two lines in one or two states. However, if there's one thing we've learned, they can all go insolvent, and they can also all be quite strong. Some are near or under regulatory scrutiny, and several have healthy surplus levels and RBC ratios. And the near or under regulatory scrutiny is pretty important because some of these graphs and charts, some of the companies have really funny numbers, but because they're under regulatory scrutiny, maybe they have less surplus, but it's okay, or when a company is actually liquidating a lot of business, it can make all of these ratios look very funny. And there's a great variation in surplus from millions to billions. And development as a percent of prior surplus can range from under 1% to over 100%. A couple bad claims for a niche writer, that develop can set off the IRIS ratio, whereas for a very large commercial insurer, they don't want reserve development on claims. However, having a couple that blow up, it's not going to take the company down at, maybe a nominal 1% development. But in terms of dollar amounts and in terms of the industry, it's still large. So here are some graphs. These, the 1-year reserve development surplus ratio, this is an IRIS test. And I just want to point out a few quick things here. The orange line here is this is a mortgage company, so yeah, I had a little bit of movement here. Then the mortgage crisis happened, and the development that's here outside the range of the graph. Then they reconsidered it in 2009. Then, in 2010 they reconsidered their reconsideration. In 2009, it's a very volatile line of business. I wanted to point out a couple other ones here. We had this green is a commercial auto writer here. They were at or below around not much reserve development at all. And the last few years, as a percent of their surplus, they've been it looks like between 5 and 10%. And there's also a regional multi-line. I'm trying to be very general here. This company here, it's been on the top 30 a few times. They used to develop anywhere from 10 to 20% between 2002 and 2005. And it's been doing a good job of stabilizing. So right now it's between 5 and 10%. So we have the 1-year development to surplus ratio. We made these dandy charts, but there's not really much of a stretch to make the 2-year. And again, the orange one, the mortgage company, it looks a lot more, compared to the 1 year, it's a bit more stable. On the 2 year, of course, they went up, down, up. So the up and down, and then down and up are going to stabilize themselves. Again, you can see the developing around 10% of its surplus. So then we got one more metric here that I found quite interesting. Authorized control level, risk-based capital ratio. So our commercial auto insurer, these guys, according to the risk-based capital anyway, these guys are pretty healthy. They got over probably 9% in the last 3 years, or 9 times, the risk-based capital requirements. Now, the risk-based capital requirements are funny. Refresh everybody's memory. Your threshold is 2 times the risk-based capital requirements, and that's company action level. And 1 times is authorized control, but 2 times is company action level. You do not want to be below 2. Like our mortgage insurer, in fact, let's say our mortgage insurer is at this point going to be in liquidation or rehabilitation. I know that in arrangements like this, even if they're still alive, they may get special treatment for risk-based capital. And it could be perhaps, since we started this project in June, for some ISP regulators and ISP Illinois State University, perhaps they didn't have this number filed yet. And maybe even filing it, maybe they have to hand deliver it or something. I mean, when you're in rehabilitation, they're watching everything you do. And there are, we had a reinsurer, large reinsurers that 02, 03, and 04 were near 2. Now they got double the company action level requirements. So as far as risk-based capital is concerned, my sample cohort of companies, they appear to be pretty healthy overall. Now, I've had some comments on this. Pinnacle itself is not going to make any much conjecture before this, because reasons why companies increase or decrease reserves on a specific company level that is outside the scope of this presentation. But this theory can be used if you're analyzing an individual company. Money from profitable years may be used to cushion reserves in poor performing years. So if you have a lot of profit in 2007, you might take some of that profit and boost your asbestos reserves from the late 1960s. And it can help, even out some of the effects of the underwriting cycle. And then one of my colleagues says, a lot of times if you're doing this method, or you may end up choosing the conservative end of a range of reasonable estimates, if that's what, if you're developing reserve rate. And conversely, companies that are performing poorly, they may increase their reserves to appear strong. They don't want a rating agency downgrade. They don't want the regulatory scrutiny. And oftentimes that may be at the low end of a reasonable range of reserves. I think that second bullet is quite important, as oftentimes, and again, I initially present this to regulators. The regulators do not want the headache of an insolvent insurance company in general. That's what they tell me, and I believe them. And companies do not want that rating downgrade because I have seen the effects, especially from that A to B when a lot of your business needs that A-rated paper. So this is going to be we're still going to be talking about the top 30 because that's a great, we've done a lot of work on that, but we're going to go to more industry type of metrics right now. But let's just recap. The top 30 is characteristics are influenced by the financial condition of the industry. A bad year for the top 30 may be a leading indicator for the industry overall. However, in the past 10 years, surplus has grown for both the industry and the top 30 more often than not. So, being on the top 30 doesn't necessarily, doesn't portend disaster. I'm going to take one more question. So, within the industry, okay, the question, I just want to clarify. When I said that 46% of the opinions were signed by employees, that number is actually from the top 30. I do not have the industry numbers on that right now. And again, that's another metric that would be great if we ever get this statement of actuarial opinion, exhibits A and B electronic. I think the actuarial profession as a whole would be interested in that number just as I got to throw out the word factoid, but it'd be a great data point as people explore why certain behaviors. The relative mix of industry industry premium line of business has not changed much in the past 5 years. There has been significant changes in the top 30. So the composition of the top 30 companies changes each year. And for example, Financial Guarantee arrived on the top 30 for 2008 and 2009 for the first time. So I made some graphs. So here we have the 2010 industry versus the 2004 industry. These two graphs look very much the same. You got roughly 50% of the premiums homeowners and private passenger auto. The green part of the pie chart is workers' compensation, and we got some general liability here that's teal. Purple is medical malpractice. And so right here I have 2010 top 30 versus the 2004 top 30. And here, now, and the reason I bring this up is 2008, it was pretty famous if anyone heard it. We called it a boring year, but 2008, the top 30 here was mostly personal lines companies. It was, there was not a whole lot of large reserve development from the traditional workers' comp, large GL lines of business. So there were some very large, I'm going to say monolithic companies that when they have what you would call a minor reserve development, it was a huge amount of dollars. A lot of those companies write predominantly personal lines of business. So 2008 was trash. It's always worth to note this because as I said before, the makeup of the 2010 industry and top 30 is resembling a bit of the traditional mixes when we started this. I'm making a liability asbestos reserves. Then again, the biggest exception is the financial guarantee market. Now, the next two charts are going to compare loss ratios and surplus for the 2010 top 30 to the industry over time. The loss ratios are accident year from Schedule P, and the surplus results are from an industry snapshot run this summer. The data we use is great. I really like that we can get consolidated group data and consolidated industry data. And makes my life easier, and it's a lot less spreadsheet work, less chance of error, software. However, the data comes in flows as annual statements are issued and or amended. So the point is, I looked at the total industry numbers from the data source I have now. It might be slightly different, but we wait till midsummer when the lion's share of the data is in our CDs. Right here, when we're looking at the historical held ultimate loss ratios, the latest three accident year loss ratios for the top 30 are higher than the industry. We can see that right here. This is one thing that could signal potential hardening of the market. And again, I referred to them as boring years. I don't know if they're necessarily boring years. That might be poor word choice. But in 04, 05, 06, these loss ratios are close. Sometimes, the top 30 in 04 was actually lower than the industry. And in 03 as well. So the reversion back perhaps could, the reversion back may signal a change in the market. I'm gonna, let me look at one more and then I'm gonna do a review of my comments here. So, here is the historical surplus for the top 30 and within the industry. Top 30, 1 year surplus remains positive after large negative surplus growth in 2008. And oftentimes when I'm talking to regulators or students and we discuss statutory surplus, and we had to read about it for exams and so forth, but I refer to it as the piggy bank you have. And I'll tell you, I think a lot of people's piggy banks, and I included may have been negative in 2008 if you're invested in equities. So I don't think that really says too much about top 30. But the big thing is the industry is growing. It's surplus is growing. 1 year and 2 years is growing more for the industry than top 30. The other thing we noticed that prior to 2004, and this is when the top 30, those companies were really bad, and the industry wasn't necessarily behaving great. The top 30 was, that was a really bad attempt at a box. I actually have a thing here that'll make a box. There you go. The top percent of the top 30 was actually, percent of surplus was a bit higher in 02, 03, 04 than it appears to be in 2008, 9, and 10. Okay. We have the question, can homeowners have large development, or how can homeowners have large development? Homeowners isn't necessarily in the top 30. However, what those pie charts were mixes of business run by companies within the top 30. So a company that might write homeowners as well as some commercial liability, my guess is that the reserve development that get them on the top 30 would in fact be from their liability or occasionally private passenger lines. Let me see here. The top 30 changes from year to year. And we're going to have a lot of graphs and charts in the last 10 minutes that are going to explore that. So hold on to your handlebars. We got this left 10 coming right now. We're going to start. This is graph numbers down. I made these curves. So the red lines it's the percentage of companies where reserve development was negative. Purple is the percentage of companies where reserve development was positive over a given calendar year. So Yeah, it really is a beautiful graph. But you can see right here, when the industry was really bad around 2001, 2002, 2003, right here is where the lines are very close. And right now, for the last 5 years, roughly 70% of the companies have had negative reserve development, and somewhere between 20 and 30 have had positive reserve development. However, back in its heyday, the 01, 02, 03 days, we had anywhere from maybe 38, 39 upwards to 45 companies. Almost 1 out of 2 were understating their reserves based on their calendar year development. So now we're going to look at a few more industry metrics. So now in 2003, we would expect deterioration in industry income metrics, and this is obvious because several times in this presentation I said those years are turbulent, and there were several prominent insolvencies, and S&P published that article about actuaries, and they used the word naivety and knavery. So right here I got industry reserve development, that's the blue bar, versus net income to surplus, that's the red line. Note that the excess here is actually 6%. So, one conjecture, and at this point it's conjecture, I don't want to be, sound too much like an economist. I have a minor at college a while ago. We do have a curve forming here. Remember, 2008 had that one weird situation with the credit default. So, one would expect that if this blue line continues, at some point, 1 year reserve development is going to pretty much be null. It's going to be around 0. And at that point, I would expect the net income to be somewhere around 6%. From this graph, you can see, again, a lag or two of the year, but the 6% net income slash seems to be where the 1 year development at null is. Obviously, there's well beyond the scope of this presentation. There are huge relationships between income and 1 year development. So now we're going to look at underwriting gain, and we're going to see again a very similar pattern. Drawing graphs and curves of the mouse isn't easy. And here we're at -5% is kind of our line. So when the industry reserving seems to be doing really well, you see -5% underwriting roughly, which that makes sense to everything I learned in college from if anyone knows Jim Carson. But there's always underwriting. You lose on underwriting, make money on investments. But you can see here where there's really strong 1 year development, there's really low negative underwriting gain. So I have a few more conclusions. So reserve development has an inverse relationship with underwriting gain and net income. If and when reserve development for the industry becomes positive, we expect underwriting gain and net income. I'd say be negative. Underwriting gain below 5%, or -5%, and net income below 6%. I do not need to be negative on this conclusion. However, the graphs they do show a slight lag of a year or two. And again, this conclusion, this conclusion is kind of one of the conclusions of this whole thing. A bad year for the top 30 may signal a bad year overall. And I got to read a couple of comments before I believe we got one more section. One question on my change in surplus for the top 30. My surplus for top 30 as a time series is for the current top 30. It's not the top 30 from each year. At this point, we have enough data. I should probably at some point construct that. One neat thing about this, this particular research thing, I can make a whole lot of graphs. There's a lot of data out there. So any suggestions on graphs or charts are very welcome, because I can add them in, and like I say, I'm trying to make a very visual presentation. And I have a comment that says, from a member of my audience, that says 34% is the percentage of SAOs that employees signed in 2010. Thank you very much. Okay, so everyone's asking, we call these the repeat offenders. One, your reserve element was run for each of the past 15 years by group. 172 groups made the top 30. What frequency of groups making this list? Well, we got a handy-dandy chart. Before I forget, I'd like to thank my colleague Darcy. She helped me out with these graphs, too, by the way. I'm very indebted, by the way. It's always good to have helpers. We have one company here that's made it 12 times out of 15. One company's made it 10, and two have made it 9. Now, I believe one of these companies is either an 8 or 9 is well been gone by now, and I think maybe 2. 30 lists doesn't mean you're insolvent. I haven't really dived into that one. So, but here's some of my conjecture. We have 16 groups that have appeared at least 7 times in the past 15 years. And again, sometimes very large entities, they make money, they're going to boost their A&E reserves. And all but 5 of these had increases in surplus between 2003 and 2010. One company is at advanced stages of insolvency. And another thing I learned is that some companies are able to maintain really strange surplus levels or RBC levels because they write a line in a state. No one else wants to write that line in the state, so the company will allow them to write this line in that state because it's needed, and they can have what I call funny-looking surplus, risk-based capital, and pretty much any other ratio. So when you look at some of these top 30 companies, that will explain some of the ratios that look a bit out of whack. Historical surplus here for the repeat offenders. In 2010, we have, 1 minute, wrong sheet of notes. I did prepare notes, so, and I grabbed the wrong sheet. Company number 3 and company number 7, you can tell here that they're in runoff. The surplus is going down. Although company number 3 has a lot of runoff, although theoretically they're still writing a little bit direct. Historical underwriting gain to earned premium. In the year 2010, out of 4 positive and 10 negative. No, I hid companies 3 and 7 because those numbers were so funny looking that they were not going to add too much to discuss if you're looking at charts such as this. However, the 10 negative, as we said, the industry's negative. We looked at the graph and said, it's normal to have negative underwriting profit because you're making money off the interest. However, we'll point out that the interest in somebody did make a lot of money in 2006, 2007. And a lot of them proceeded to, 2008 wasn't a really good year for a whole lot. So, in 08 and 09, roughly half the repeat offenders had underwriting losses. 02 through 04 were a lot worse. And, 06 and 07, there was a lot of positive underwriting results. We saw that for the industry. And since we're seeing that positive to negative, it's some evidence where the soft market's reached a point where it's putting pressure on underwriting results right there. And here we're going to look at some profitability. Here's net investment gain or loss to surplus. I noticed, here that we had a 2010. The industry is 10%, and several companies are above or below. However, from 2009 to 2010, most companies had an increase, and from 2007 to 2008, there was definitely a lot of negative here. The company's investments were affected by a general terrible stock market. Historical net income to surplus. We have, again, on this, I hit company number 7. The industry is 6.7%. I believe I did a count. 9 of these companies were actually greater than the industry. So, several of these companies are doing fairly well. All but 3 of the companies had reductions in investment gain surplus from 2007 to 2008. This includes the industry, and here we all agree. The industry net income was 6.7% of surplus in actually I believe 2010. 5 of the 15 had net income in 2008. Of those 5, only 2 are larger companies, though, with negative underwriting gain and negative investment income. So then I made some more profitability trends. I graphed net income, investment income to surplus, and underwriting gain. And basically, we have these by individual companies. I graphed 2006 and 2010. I think the key takeaway here is, if you look at the industry, and these companies are going to change up, but here the industry has positive underwriting gain, positive investment income, and poof, positive net income. And oftentimes this blue bar is a lot of times the combined effect of the purple and the light green bar. However, in 2010, the industry is still profitable, but the underwriting gain is starting to be negative. And 1, 2, 3, 4, 5, 6, 7, 8. We got 9 companies here. We got a lot more companies with negative underwriting gains. And this right here is going to be the last section of this presentation. It's some ending thoughts with some industry stuff and Schedule P. Schedule P from a high altitude, I call it. We make a chart like this thing on the left. And the initial incurred valuations of 12 months incurred loss for Schedule P includes IBNR as of 12/31 of the year. Excuse me. The second column is a mature evaluation. So it's coming from a Schedule P and it's several years more mature. 2009 is obviously we only got 12 months, but we don't have as much info on here. So we use this to make some charts and graphs here. So this is total industry accident year original versus mature loss development. It looks a lot like the underwriting cycle. We have the positive development that coincides with the high loss ratios in the underwriting cycle here. And then where we're in a soft market, we have negative net development and overestimation. And right here in 02 and 03 and like 97, 98, that inflection point we've seen in other graphs, whether it's underwriting or net income, or the graph where we just graph the relative percentage of companies that show reserve increases or decreases. Not even dollar amount, just the number of companies. We also have this graph for stock versus mutual insurance companies. As was expected, stock companies and mutual companies have the same pattern. The stock appears to be much more volatile. And that's because mutual companies are probably, they're not going to have as much incentive to wildly increase or decrease their reserves one year to the next, whereas sometimes stock companies, depending on their situation, are perhaps going to try for a bit more precision, of course. To an extent that they're off, you will see a chart that looks like this. Here is one repeat offender. It has a similar looking pattern, except it was positive development 08 and 09. Probably why they're a repeat offender. And I graphed all the repeat offenders, and again, found a very similar phenomenon. So we end up with this curve. Whether we look at different lines, the industry, stock versus mutual, repeat offenders. So this is let's look at some loss ratios. This is our internal analysis of Schedule P data as of 12/31/2010. Here's another example. Now this is a great underwriting cycle. It's comp. I always put this here. Again, regulators, and we do have some non-actuaries on here, and everyone has talked about the underwriting cycle. Workers' comp is a great way to visualize the underwriting cycle because the numbers just fall out, and you don't even have to work that hard to make this graph. And this curve looks better than I can draw a curve. So I always use this as an example near the end. However, we also see the general commercial casualty coverage, as we see, the underwriting cycle. Note that 2005, 2006 appears to be the bottom of something. Things are going up, and right here, products and that's workers' comp and products. The GL's wagging around at the bottom, but products is definitely showing the look of an upward trend in the underwriting cycle. And personal lines never shows the cycle as much. Other than that, 06 and 07 were really good years, and the years after that, I don't even know if you want to call it deterioration as opposed to maybe returning to normal. And there's a curve in here, but it doesn't look nearly as extravagant. So, for the 5 most recent policy periods, workers' comp has shown an uptick, as has other commercial lines. The market's been soft for several years. Question, can it be soft forever? I would say probably not. Because soft markets, they increase pressure on premium. If you're lowering your rates, you have to write more risk. And if you write more risk, occasionally you got to write some bad ones. And all those risks need loss reserves, and so you'd expect to see more commercial casualty in the future if the market's going. If the curves on my charts before follow what they've done before, we'd expect some more commercial casualty. One of the member of my audience brought up a great point that I haven't thought of. Mutual companies do tend to be personal lines, and that's another reason why that mutual versus a stock graph is going to fluctuate like that. And perhaps, again, another future graph we could make would be a graph overlaying that Schedule P from above graph, perhaps doing workers' comp, medical malpractice, and private passenger auto. That might be a really good one to add next year. Thank you very much. And, okay, we looked at the 30 companies with the largest one-year development in terms of dollars, and they have all sorts of characteristics. A lot of them are strong, a couple are going insolvent. Mandatory statements of RMAD make it easier to assess industry-wide causes of concern, and repeat offenders are, showing much better loss ratios and surplus growth as a group, going forward from 2003. And that right there is the end of this Apex webinar, or all the housekeeping stuff. I'd also like to thank our IT people. I know everyone out there in all their company has IT people. We do too. And they enable events, our research and ways to publish and broadcast our research. So thank you very much. You'll be getting an email asking for feedback. We will, in that email, you'll find ways if you want to get a certificate to prove, for your continuing ed, for your documentation, send the email. Again, we ask for your feedback. If you'd like copies of the handouts, there's also a way through that email to get copies of the handouts. They should be on available through our website, too. And you can always email me any questions. I'd like to discuss this stuff. Thank you very much, and thank you for a lot of people. You got a lot of great questions. I appreciate it.